as an individual and you pay him interest, so that is the cost of borrowing. Similarly, if the company borrows money in any form, I have written only one, there are several which I'll discuss with you. So if company borrows money from somebody, from a group of individuals or individual, it pays them something called interest. So it is a cost of that particular kind of capital. So cost of capital means the cost that we incur in obtaining that component or that part of capital. So the meaning should be clear to you. Introduction to cost of capital. That is why it is called as financing decision. Why is it called as financing decision? Because once you borrow money or once you take money on any agreement, on any basis, on any mutual consent, that money is used for investment. How do you finance that project? That part we shall discuss in this unit. The cost of capital means the cost that company incurs in taking money from public. Now, as I said before, right on day one when I took first session, it was on general financial management. Similarly, while discussing first unit, Khalisa must have talked about, and while discussing third unit, I have discussed in detail that all the financial decisions will be taken in view of the wealth maximization concept, maximization of shareholders' wealth. Can you relate financing decisions with maximization of shareholders' wealth? Can you relate maximization of shareholder wealth related to financing decision, or to be specific, cost of capital? Anyone can answer? If you are not able to relate, I'll explain. I mean, if you can find. Okay. How is wealth maximized in any organization? Wealth is maximized in any organization if the project it accepts are profitable. The investment decision it takes, if they result in more inflows than outflow, of course discounted one, then the shareholders' wealth increase, and otherwise shareholders' wealth decreases. You have studied in detail in unit number 3. Especially recall IRR. If the project is financed in such a way that return is more than the cost, it will result in wealth maximization or wealth deterioration. So come back to what I was discussing. In what way wealth maximization is related to the cost of capital, or to the project financing, or to financing decisions? It is related in such a way that when you arrange capital, either borrowing or through equity or through any source, it costs you, it costs the company. If cost is more, naturally inflows will be less. Net inflows, overall inflows will be less. If cost is less, inflows will be more. Suppose you borrow something at 12%, so you will pay rupees 12 per year. If you borrow at 9%, you will pay 9 rupees. If you borrow at 7%, you will pay 7 rupees. So more you pay, less will be the profitability and net inflows, less you pay. Just like any simple profitability calculation, either you increase revenue or you decrease your cost. That is why in the financial management, we shall discuss how to obtain money using less cost. That is, we will first calculate how to calculate the cost of capital. Apparently it seems very simple, but when we go into calculation, then only we will realize real use of financial management. So in case a company arranges money at a higher cost, it loses, else it gains. Therefore, one can say that the concept is directly related to wealth maximization concept of financial management, which is our objective. If this introduction is clear, I'll proceed further. or if you have any questions, please ask. Shall I proceed?
Yes, sir.
Okay. Now, next question, next issue is, we have concluded that cost of capital is necessary, cost of capital is important because of these reasons. Now, we may finance a project primarily using two sources, equity and debt, or you can say capital structure of any company with which it operates on long-term basis could be equity and debt, or equity or debt, or a combination. Equity basically profit sharing, and debt is based on fixed charge, irrespective of the profit or loss in the company. So a project can be financed, a company can be started primarily with either of these two sources, or one of these sources, or a combination of these two. A company initially may start with entirely equity, not possible entirely with debt, but some equity and some debt. Each has got several types also that we shall be discussing subsequently. Now, equity, you all know, based on profit sharing. If there's a profit, shareholders will get. If there is no profit, they will get nothing. If there's loss, they will share losses also in proportion to the amount that they have invested. Now, if the funding is there, which is not based on profit sharing, but it is based on fixed charges, it could be interest, it could be, several words are there, but main characteristic is that the return is fixed. The return is fixed, no matter company makes profit or company suffers losses. So it can have primarily these two forms. Now, rationale and relevance with shareholders' value, I have just now explained that if company borrows or if a company arranges at a higher source, it ends up paying more, and ultimately, less profit will be there, and less inflows and less maximization of shareholders' wealth. Now, types of capital and calculation of cost of various sources of capital. This is what the overall content of your fourth unit would be. Now, what are the types of capital from which a project can be financed? Debenture. It is again a fixed source, a fixed charge fund. Similarly, there can be preference shares. Again, a fixed charge. Can you think of some more sources of funds which are, of fixed charge in nature, or which belong to first two categories?
Sub bonds.
Say it again, please.
Sub bonds.
I'm sorry, I still did not get you.
Sir, corporate bonds.
A corporate bond, you're right. Bonds, correct. Bonds, fine. Let me write here bonds. Then, what else? Bonds.
The bank loan.
Loans. Okay, loan, correct. Then, you are all right. Go ahead. Loans, fine. Anything else? Commercial papers are there. Then, global depository receipts are there. There are other forms also wherein government or renowned established business houses float those instruments against which the public in general subscribes, and main condition is that the return to them would remain fixed irrespective of the project being profitable or running into losses. Then there is another category known as, let us say, equity. A company can raise money by issuing equity shares to the shareholders. The interested ones will buy, and the condition would be, if there's a profit, they will get. If there's no profit, they will not get. Another source which is an extension of your equity is retained earnings. If the company has been in business for several years, it may have lot of money which it saved from previous year's profit. In previous years, it made profits, and that money it saved. So whatever money it saved in the previous years, with that money, it can finance the project. So that is known as retained earning. What could be the other name of retained earning?
Reserves and surplus.
Reserve and surplus, correct. How do you differentiate between a reserve and a surplus? Are they same or there is a difference between the two?
Surplus is unallocated.
Surplus is
Unallocated.
unallocated. Explain it a bit more. Surplus is one which can be used for any purpose. Reserve is one which can be used for the purpose for which company has reserved. It is theoretical, which I have explained to you. Practically, everything can be used anywhere. It is entirely dependent on the decision that the stakeholder wishes to take. They will simply convene annual general meeting, put up a proposal, and that proposal will be through. They will say, we wish to use this money for this purpose. Go ahead. They will use it. Practical, they are all the decision makers. Like in Government of India undertaking, any Government of India undertaking, whatever government wants, it will convene a meeting, and that too for the purpose of fulfilling the legal requirements. It will float a proposal because government holds 51%. So whatever decision it takes, it will be implemented. But anyway, the theoretical concept should be clear. So there may be loans, there can be bonds, there can be several things, and then there can be equity, there can be retained earning. Put together all, what do we call this? If we call debenture, shares, equity, retained earning, everything, these are called as capital structure. A capital structure of the company may consist of one or more of the highlighted sources of capital. This I just forgot to explain to you. This is commercial papers, global depository receipts. You can raise money from Indian market, from overseas also. Company can issue receipts, depository receipts from all over the world. And because if you study the financial system of our country as well as of other countries, about 10, 15, maybe 20 years ago, there was a huge difference in the financial market, Indian financial market and the world financial market. Cost of borrowing was extremely expensive, very, very expensive, 16%, 17%, 18%. Legally, this much was the interest rate that people have to use to pay to the bank. In the same system in foreign countries, it was very, very cheap. So people started, after taking permission from the government, raising money from the foreign markets. It resulted into a healthy competition, and the interest rates were reduced. There may be several things which economic expert would be knowing, which I am not aware, but I only know that it was very, very expensive, maybe about 20, 25 years ago, 15, 20 years ago, which now has come down drastically. And same is the case on return on savings also. I remember having received 12% return on public provident fund, which is compulsorily deposited by the employees. These days it is 8%. In some places it is only 3%. So rate of return on investment has decreased. So the rate of return being charged has also been decreased, has been reduced. So there were, these are the various sources. Once we have come to know the meaning of cost of capital, various sources of cost of capital, and also its relevance and rationale with maximization of shareholders' wealth, then we will take up various types of capital and see how do we calculate the cost associated with each capital. Is this slide entirely clear to you? Okay. Now we start with the first kind of capital, cost of debt, popularly known as debenture, either debt or debenture. One of the same thing, cost of debenture or cost of debt. Now, meaning of debt or meaning of a debenture. It is a kind of instrument that the companies issues to the public at a at an agreed rate, and a company continues to pay them that percent return and call that return as interest. If I say a company has raised a 10% debentures, so 10% debenture means company is paying 10% interest to the lender, to the people who have bought. So can we say that the cost of debenture, if it is 10%, so cost of capital becomes 10%? Can we say or not?
Yes, sir.
Say it a bit louder.
Yes, sir.
If we say a company is paying 10% interest on the money it borrowed in the form of debentures, can we say that the cost of this capital is 10%?
Yes, sir.
Okay, fine. Anything else? Any other, any other concept that you would like to introduce here? Why I am asking because we have already discussed this concept, and here is the time to recall that concept and apply it in real life. If it is so simple, that company is paying 10%, therefore cost of is 10%, why should we include 5-10 slides, and why should we explain calculation part of it? Recall that we have discussed concept called relevant inflow, relevant outflow. What is the basis of decision making? Profit or cash inflow?
Or cash inflow.
Cash inflow. Okay. Before we arrive at cash inflow figure, several adjustments are made. One of the adjustment is payment of taxes. Do you agree?
Yes, sir.
Now, before I take up this one, let me ask you a question. You have two options. Listen to my this one, because writing will take time. Therefore, just to save more time, I'm just trying to explain to you verbally. You have, each one of you have got two options. One, 10% interest from a bank. 10% interest from a bank. Another option, 7% interest from post office. 7% interest from post office, which is tax free. Which is tax free. I'll repeat. One of the options is 10% interest from a scheduled commercial bank like SBI, PNB. Another option is 7% return from post office savings, which is tax free. Which one will you accept? 10% or 7%?
Sir, I need to know the principal amount first for each.
Doesn't matter. It doesn't require. What difference will it make if the principal is 1 lakh or 1 lakh crore? Will it make any difference? Okay. Assume anything of your choice. Let us say 1,000 rupees. To make it simple, or maybe to answer to not to make it complicated, let us say the principal amount is you can invest 1,000 rupees. Should you invest in post office saving, which is giving you 7% tax free return, or will you invest in a bank offering you 10% interest? Where will you
Sir,
invest?
bank.
G?
Bank.
Because?
Sir, maybe my income is already taxed.
Maybe my income is already
Taxed.
taxed. Any other answer? See, the answer lies in what tax bracket you are there. If you are paying taxes, you are rich enough and you are paying taxes, then you will calculate. If I invest in a bank, I get 10 rupees, 10% return on 1,000, I'll get 100 rupees. How much taxes will I pay? Suppose you pay 35% tax. So you will be left with 6 rupees and 50 paise, which is less than the offer from a post office bank, isn't it? That means we cannot take a decision merely on the basis of face value of an offer. We will adjust the offer with respect to several other considerations such as the taxes, such as rebate, such as several things. In this particular example, you see, if company goes for something on which it can claim some tax benefits, I'll repeat, in case company raises money from such a source wherein whatever it pays, it gets some tax concessions. So company will first of all factor in the taxes part, then only decide the real cash outflow. Now come back to the actual concept because of which I gave you this example. Company is issuing some debentures carrying 10% interest. The question I asked, does it cost company 10%? The answer is no. No, because the interest that company pays is a tax deductible expense. Company can claim and company will claim tax benefit. Suppose the company is in 40% tax bracket. A company is 40% tax bracket. What should be the real outflow for the company? Rupees 10 or rupees 6? It is rupees 6 because company is saving 4 rupees in the form of taxes. So decision making basis would be 6%, not a 10%. This has been explained to you in subsequent slide. At this slide, the idea was that simply by saying that we are paying 10%, we cannot consider our cost as 10% because it has to be adjusted with the concept of relevant inflows, with the concept of depreciation, etc., etc. Now, a company can issue debentures. The debentures can be of various types. Let me check if yes, can be various types, such as convertible and non-convertible. It means at a later date, these debentures can be converted into equity shares. If it carries this clause, they will be called as convertible. If it carries a clause as non-convertible, that means debentures will remain debentures till these are redeemed. When I say these are redeemed, till such time when company pays you back your original amount. You bought today debentures of rupees 1000, 10 debentures of rupees 100 each, 1000. After 5 years, the redemption time has arrived. Company has paid back you your money. So it is known as redemption. So if these are non-convertible, so they will remain as debentures till such time these are money is refunded. If these are convertible, after 2, 3, 4, 5 years, at an agreed clause, at an agreed ratio, these will be converted into equity shares. So you can call them as convertible and non-convertible. Redeemable and irredeemable. Theoretically, it is mentioned redeemable and irredeemable. Practically, irredeemables are non-existing in them. Redeemable means after some time money will be refunded. 5 years, 10 years, 3 years. Irredeemable, it can be sold in the secondary market. Cumulative and non-cumulative. Cumulative means if a company has not been in a position to pay interest this year, it will pay this as well as next year's interest after 2 years. So cumulative and non-cumulative. Participative, non-participative. If you are permitted to participate in the management of company, you are holding participative debentures. If you cannot, by and large, the form is non-participative only. So these are various forms. There can be others also. Once you go through the books, you will find. Now, calculation of cost of debentures, it depends on the terms of issue and terms of redemption. If redeemable, they are redeemable only. In the subsequent slide, I'll explain this in entirety. If you have any questions, ask me. I'll move on to the next slide else. Any question? Have you downloaded this presentation from Google Classroom?
Yes, sir.
You all have downloaded, or is there anyone who has still not downloaded? At least you must have got a message.
Downloaded, sir.
You could have got a message from classroom that something has been posted, downloaded. Try to go through the next session's slides so that you are fully equipped with answering questions. Now, what I have explained in the next slide, look here. What I am talking, terms of issue and terms of redemption. Issue means company is selling, redemption means company is returning the money that it borrowed. It can be issued, there can be as many as 9 different terms which I have listed here. There are concepts like par, discount, premium, which I have explained here. Par means if the face value is rupees 10 and company is giving you at rupees 10, it is known as at par. Discount means something of rupees 10 being given to you anything less than 10. And premium means something on a face of a 10 but being given to you at more than 10. Usual words, discount, premium, par. Now, what could be the terms of issue and redeemed? Issue at par and redeemed also at par. 10 and 10. I am writing here issued at par. So, a 10 and a 10. Issued at par and redeemed at par. What should I write here? 10 and what should be written? What figure should I write here where the cursor is blinking?
Nine, sir.
Less than 10. Let us say 9. What should I write here? Issued at par.
More than 10.
And it,
More than 10.
let us say 11. More than 10. I'll stop here. The rest of the figures you write on your own. But the concept is clear to you. Is that fine? What shall be written here in the serial number 9? Just tell me figures.
11 and 11.
11
11 and 11 or 11 or 12 or 11 or 15, anything. But has to be more than 10. Can be 10 rupees and 1 paisa. No issue, but more than 10 and more than 10. Fine. You can all do it subsequently. Shall we proceed now?
Yes.
Now see how do we calculate. I am writing determine inflows. So what will be the inflows for a company? What will be the inflows for a company?
Sales.
Say it a bit louder.
Sales.
Sales proceeds, correct? Sales proceeds that it realizes from the sale of debenture. You might be seeing advertisement in several newspapers often that so and so company is issuing so many debentures carrying so much of interest. Suppose company has issued 1000 debentures of rupees 10 each. I am repeating, company has issued 1000 debentures of rupees 10 each carrying 10% interest. How much money company will receive?
10,000, sir.
Any other answer? If I say that the company will not receive 10,000 because I am yet to tell you what are the terms of issues. I have not told you it is at par, it is a discount, it is a premium. All right. But if it is at par, your answer is correct. If it is a discount, 10% discount, company will receive 9,000. If it is a 20% premium, company will receive 12,000 rupees. So depending on the terms of issue, you can take first step, you can determine what is the total inflow. Do you think some adjustments will be required with the inflows? Do you think some adjustments will be required with the inflows? Adjustments will be required with the inflows. When company issues debentures, or for that matter, any instrument, debenture or equity, anything, it incurs cost. It incurs cost. What kind of cost? What kind of cost does it incur? What
So
cost?
issue expenses.
Issue expenses, correct. Then issue expenses. At least the advertisement will cost huge to the company. Flotation cost, consultation cost, brokerage cost, underwriter's commission. The company is not having a bank. Company is not operating a bank. Company is going through it through a investment banker, through some merchant banker, through somebody to which company will pay some money. So whatever are the costs associated with the issue will be subtracted. So we will come to know the net inflows. So once we determine the net inflows, we take the second step, determine outflows. What could be the outflow? What could be the outflows? Once you have borrowed money in the form of debentures, what will be your outflow?
Interest.
What is the expense? I have written only half of it. What is the expense? Will you forget after borrowing money, or you will pay something to them?
Sir, interest.
Tell early interest. What else? Every year you will pay interest. What else will be there? Redemption value. After 3, 4, 5, 6 years, whatever was the time of redemption, you will pay back the money. So total of this, which I have written in bracket, will be your outflows. Is this part clear?
Yes, sir.
So what is redemption value?
Okay, redemption. I'll explain it as many times as you ask me. But if you come here, what did I explain here? Redeemable. What was the meaning that was explained to you, for not you, the entire class, for this word?
Sir, when the company pay back the amount.
Correct, you are right. Same thing is applied here. Redemption means whatever company pays back after the expiry of agreement. Suppose company entered into any agreement that we are selling so many debentures of 1,000 rupees each, carrying 10% interest, and they will be redeemed after 5 years. So means at the end of 5th year, you will get back your money. How much will you get back? Depends on this. Suppose the agreement was at serial number 6. You might have given company rupees 9, and how much will you get? 11. Serial number 6. Am I right?
Yes, sir.
So come back here. So at the end of this second I am explaining, at the end of that time period, you will get redemption value. If the agreement was 11 rupees, 10% more, you will get 11. If the agreement was 30% more, you will get 13 rupees. If the agreement was a 30% discount, you will get only rupees 7. Okay. Now, 2 steps are clear. I mean, is there anything to be asked in step number 1 and step number 2? Any question up to this stage? Or this is clear to you?
Yes, sir, clear.
It's clear.
Okay. Why, sir, the advertisement code and under
Just 1 second before just 1 second. Has everybody entered his or her name? Those of you who are yet to enter, please enter your roll numbers if you have not already. Now, what is the question? Say it again.
the advertisement cost and underwriting
Okay.
cost, why we are not counting it in the outflow? Why we are counting it in?
Okay. Why are we not counting in the outflow? Why are we counting in? Why are we subtracting from inflows?
Yeah.
Fine. Mathematically, what will you do? Just try to visualize situation. What will happen? The issue is taking place on 1st January. The interest will be paid on 31st December. At what point in time the expenses are taking place? 1st January or 31st December? 1st January. How much net money will you receive? Will this happen on 1st January or 31st December? 31st, it will happen on 1st January. Therefore, whatever are the net inflows as on date, the day of issue, will be worked out. And if you want to subtract them, there will not be mathematically correct situation. Why I am saying it will not be mathematically correct situation? We will explain to you, I'll explain to you at serial number 3. You have determined inflows, you have determined or worked out outflows. Third step is equate them at an appropriate discounting rate. Read this line carefully and tell me why are we doing so. Equate them at an appropriate discounting rate. Have you understood the meaning of this sentence? Have you understood the meaning of this sentence? Equate them at an appropriate discounting rate. Am I audible to all of you?
Yes, sir.
Yes, sir.
Okay. I'll stop the class here. I will not say anything to you in the coming 5 minutes. I'll just keep silence. Nothing I'll explain to you in the coming 5 minutes. Switch on your mobile. Go to the WhatsApp, not individual. Go to my personal number. Go to my, when you write in, explain the meaning of this third line. Equate them at an appropriate discounting rate. I am looking at my mobile. Don't do anything. Just post the meaning of this word. Equate them at an appropriate discounting rate. This is something very, disturbing. I'm feeling a bit disturbed about it. You are not studying English language. We are discussing financial management. It is a sentence written in English, but it is a financial language. You should know its meaning. And especially when this has been explained to you several times. Even if I give you some benefit of doubt about Khalid Sahab, I have explained to you several times. Continue writing like this. I am receiving answers from, I have received so far 1, 2, 3, 4, 5. I'll not wait here until infinite time. I have to cover your syllabus and I have to teach you also. Why should, you should write as fast as you can. If I continue sitting idle, I don't feel like it. It's very bad and your time will be wasted. Okay, let me, now you may stop sending whosoever has sent so far. Last I have received from Rafiq. Now you can stop. Let me explain to you the logic. It was really disturbing. Why do we do so? You see, you are receiving inflows, let us say debentures were issued today, 13th September 2021. What will be your yearly interest? When will you pay first interest? You will pay first interest on 12th September 2022. Second interest, 12th September 2023. If it is for 5 years, you continue, you will pay that interest every year. At the end of 5th year, let us say 2027, you will pay back the money that you borrowed, because you are paying money at the end of first, second, third, fourth, and fifth year. The value of that money is not the same, what that is equal to the value that you are receiving today. It is plus today, but minus after several years. Suppose it was 100 rupees only in close. Let us theoretically assume that you have received 100. Now you have paid every year 10% interest, and so for 5 years interest will be 50 rupees on 1000. If we say 1000, interest will be 50 rupees on 1000, and 1000 you will pay after 5 years. You will pay 1000 rupees also. So every year 100 rupees an interest, and this much the total money that you will pay will be 1500. Is the calculation clear? You have issued debenture worth rupees 1000 carrying 10% interest, and the term is 5 years. In 5 years, you will pay a 500 interest every year 100. So in 5 years 500, and 1000 rupees you will pay at the end of 5th year. So total money that you will pay will be 1500 in 5 years. So apparently plus 1000 minus 1500 is equal to minus 1500. Sorry, minus 500. What is the percentage of this? How much percent have you paid?
50%.
50%. Are you sure 50%?
So 150%.
Or each one of you is sure 50%? I will hold this question. I will not answer you this question. What all I can say, this kind of silly mistake you should not make. Especially, you have attended 50 sessions in accounting, and now it is 10th session in financial management. After spending so much of time with me, I have been giving you several examples talking about something which is practical, and you still are making that mistake. 50%. Okay, forget about the calculation. Think of it, we are talking corporate issuance of bond. A company is issuing bond. You as an educated person are buying bonds. Will you ever pay to somebody 50%?
No, sir.
Tell me, will you or you will not? If somebody says, I will charge you 50%, will you agree? You will immediately stand up and say, see, this bank is giving me a 10%, this bank is giving me...
Sir.
Yes. What is the correct answer then, if not 50%? Wait a minute. This is making my life difficult. Either something wrong in my teaching or something wrong in your understanding. So this is really disturbing. I'm writing something. Inflows 1000 today. Yearly interest for 5 years at the rate of 10%. 10% on 1000 is equal to 500. Refund of principal 1000. Total outflow 1500. Total outflow 1500. What is the return? To investor or cost to company? I have posted a question in the chat box. Read how it is 150%. Anyhow, I am not, continuing the class. I'll stop the class now. You just ask me if there is anything, any clarification you wish to have from me. You see the post in the chat box?
Yes, sir.
Okay. You need any clarification on this? No, you can seek clarification from me, not now. I mean, even if you need it at any time, just post me in the group. See, for clarification, etc., you always use group so that others may also learn. But for any answers, try to write it individually. So let us, what we call, leave the class now, unless you have a question on this. What I wrote on the some spelling mistake are there today. It is typically yearly interest. It is yearly interest. Look at the yearly interest for 5 years. Look at the chat once again. What is this word? Yearly interest. It has been wrongly typed. Yearly interest for 5 years at the rate of 10% of 1,500. Redemption of principal 1,000. Total outflow 1,500. What is the cost to the company? I will wait for your answers on my personal number, and don't say that I did not understand the question, so I didn't answer. Seek me the clarification on the question. You can quit the class now. You can